All right, let's dive into a change in accounting that might sound a little dry, but I promise you it was a massive deal. It basically blew the lid off billions of dollars in hidden obligations for almost every company you can think of, and it all boils down to one simple word: leases. So, could a company really have billions in hidden obligations? Oh, absolutely. Just picture a huge retail chain with hundreds of stores. For years and years, their gigantic commitment to pay rent on all those buildings was pretty much invisible on their main financial statement, the balance sheet. It was a massive financial weight just tucked away in the footnotes. You see, this whole practice of keeping leases off the books was a real problem. It meant that if you were looking to invest, or lend money, or even just work for a company, you couldn't get a true picture of its financial commitments. And that serious lack of transparency is exactly what forced a complete global rethink of the rules. So here's our game plan. We're going to look at the problem with the old way, check out the new rulebook, walk through a real-world example, and then dig into why this change actually matters so much. Let's do it. Okay, so let's dig into the old system. The standard was called AASB 117. And what exactly was so wrong with it? Well, it had a couple of really big flaws. Look, the old standard was often called out for being way too complicated, but its biggest failure by far was what it allowed companies to hide. It basically let them shove these huge financial obligations into the shadows, completely distorting how risky the business actually was. And that brings us to the hero of our story, the new standard, AASB 16. Its goal was pretty straightforward: to paint a much more complete and, frankly, honest picture of a company's finances. The whole philosophy behind this new rule is just, well, it's common sense, really. The idea is if you have the right to use something, like a building or a machine, and you have a solid obligation to pay for it, that's what's important. That economic reality is what should show up in the financials. So this new way of thinking forces us to ask some pretty basic questions. Let's say you sign a 5-year lease for a piece of machinery that's critical to your business. Do you now have an asset? I mean, you don't own it, but you do control it. And when you break it down, the answer is a resounding yes. You have a legal right to use it, so you have control. You sign the contract, that's the past event. And you can use it to make money, which is the future economic benefit. Boom, boom, boom. It ticks every single box. That right to use the machine is absolutely an asset. Okay, so that's one side of the coin. Now let's look at the other. What about that promise you made to keep paying for the machine for the next few years? Is that a liability? You bet it is. I mean, it's the textbook definition. You have a present obligation because you're legally on the hook to pay. It came from a past event, signing that contract, and it's going to result in an outflow of cash. So, yep, definitely a liability. So, with this new way of thinking, what's the bottom line? How does this all actually translate into practice? Well, it all boils down to one core principle. And here it is, the big one. The core principle of AASB 16 is super simple and totally non-negotiable. It says an entity must recognize both an asset and a liability for a lease. This isn't a suggestion. It means that, with just a couple of tiny exceptions, pretty much every single lease has to go on the balance sheet now. Period. No more hiding. Okay, that's the theory. But what does this actually look like in the real world? Let's get our hands dirty and walk through a quick example. All right, so meet Bells Beach Ltd. They're leasing a machine for 4 years. They'll pay $100,000 a year. They had some initial costs to get it all set up, and they might even buy it at the end of the lease. Seems like a pretty standard deal, right? First things first, we've got to calculate the lease liability. Now, don't let the name scare you. It's really just like the principal on a loan. We take all those future payments they've promised to make and figure out what they're worth in today's dollars. For Bells Beach, that comes out to just over $366,000. Next up, we calculate the right-of-use asset. This represents the company's right to actually use that machine. So we take the liability we just calculated, tack on those initial upfront costs, and boom, the total value of the asset is just over $376,000. And this is the magic moment. With this one accounting entry, everything changes. The lease is officially on the books. For the very first time, the asset the company controls and the liability it owes are right there on the balance sheet, clear as day for everyone to see. Okay, so we've moved some numbers around. Big deal, right? Well, actually, yeah, it's a huge deal. Putting these numbers out in the open has some really serious real-world consequences. This single change completely alters how we view a company's financial health. All of a sudden, companies look bigger because they have way more assets on paper. But, and it's a big but, they also have a lot more visible debt. This can send their leverage ratios through the roof, which is a huge deal if they have loan agreements with banks that are tied to keeping debt levels low. But hang on a second. What about the other side of this contract? The company that actually owns the asset, the lessor. Did their world get turned upside down too? And here's the really interesting twist. The answer is no. For the lessor, the old system of classifying leases was basically kept in place. This means the most dramatic disruptive changes were felt almost entirely by the companies using the assets, not the ones owning them. At the end of the day, this entire global shift wasn't just some technical exercise for accountants. It was driven by a single, really powerful idea: financial transparency. The whole goal was to peel back the curtain and give everyone a clearer, more honest view of a company's true financial promises. By dragging all these hidden debts out into the sunlight, the new standard gives all of us a much more complete picture. It forces us to ask better questions and gives us better data to find the answers. And that helps everyone, from investors to employees to you, to really understand the full story behind the numbers.